Thank you for joining us for today's webinar, Why the C-Suite Needs to Care About Data, a Capital Markets Impact Assessment, presented by Aite Group Senior Analyst Paul Simphenot and InterSystems Director of Product and Industry Marketing Joe Lichtenberg. I'm Siobhan Scanlon, and I'll be one of your Aite Group hosts. We'll be starting shortly, but first just let me take care of a few housekeeping items. The webinar will be recorded, and a link to view the recording on demand will be available to the public. We will be taking questions at the end of the webinar, so please feel free to submit your questions using the questions feature located in the GoToWebinar toolbar to the right of your screen. It is now my pleasure to introduce today's speakers. Paul Simphenot is a Senior Analyst on Aite Group's Institutional Securities and Investments practice, where he specializes in buy-side research. He covers buy-side trends in technology, operations, and regulations. His core focus is on portfolio management systems, risk management, performance attribution and measurement, environmental, social, and governance, investment accounting, and client reporting. Joining Paul today is Joe Lichtenberg. Joe is responsible for product and industry marketing at InterSystems. Prior to InterSystems, he brings decades of experience working with various data management, integration, analytics, and cloud technology companies, and is passionate about business applications of technology. So without further ado, I'll now turn the mic over to Joe. Thank you again for joining us, and enjoy today's webinar.
Thank you, and good morning, everyone. And thank you, Siobhan, for that introduction. So it's great to be here. I hope you all will find today's webinar informative. As Siobhan mentioned, I'm Joe Lichtenberg, and I'm responsible for product marketing and industry marketing here at InterSystems. And we thought that it would be interesting and instructive to work with the Aite Group, a global research and advisory firm that's focused on specifically on financial services and on capital markets, to perform detailed primary research by the way of interviews with C-level executives across both the buy side and the sell side. And in doing so, to get really a comprehensive view of their main challenges and initiatives and really what's keeping them up at night. By way of introduction, for those of you that are not familiar with our company, InterSystems is a high-performance data management software company, and we have as our customers across multiple industries, but in financial services, the top global banks, and we work closely with our customers to solve their most challenging data and analytics problems. Typically, our implementations span throughout the front, the middle, and back office processes. For example, our software powers order management systems that process up to 15% of the worldwide equity trades every single day. Next generation wealth management platforms, all of the back office processing functions for tens of millions of client accounts every day. But even so, our purview and visibility into all of the challenges at capital markets firms on both the buy side and the sell side, I would say, is still arguably colored and biased by our implementations and by the relationships that we have with our customers. So to that end, we thought it would be instructive to work with the Aite Group to sponsor the primary research that you're about to hear. Okay, so you'll hear from Paul about the business drivers and the technology challenges that the Aite Group's research has uncovered. And then you'll hear from me about the impact that we see on these trends on the technology and the architecture as a result. So again, I hope you find this webinar informative and helpful. And with that, I'd like to turn it over to Paul.
Thank you, Joe and Siobhan, for the introduction. I'll just start by saying thank you to all the viewers on the webinar for joining us today. And as Joe mentioned, we were very happy to take on the project sponsored by InterSystems and provide an update to the wider community on a key topic for capital markets, data management and infrastructure. We at Aite Group believe that data management is one of the core functions across all the business lines, and teams at buy side and sell side firms, even though in the past in the recent past, there's probably been a lack of coordination, sometimes investment at some of the institutions in this key area. And I think there are some interesting differences between the two groups, the buy and the sell side, and we'll try to highlight that throughout the presentation today. We have structured the webinar in such a way to help shape the discussion and also leading to the eventual Q&As. If you do have a question, please do participate, and we'll be happy to answer at the end of the presentation. I think we would just start off by looking at the current market landscape, which will help set the scene for the operating environment before going into the details of the study. We'll look at some of the challenges faced by these firms with the current data setups and some of the common barriers for a strong data framework and technology setup. We'll then move into examining some of the factors firms should consider for their operating model when it comes to data and desires to become a data-driven firm. Then we'll look at, give George a bit of chance to talk about InterSystems and what they're doing, and obviously ending off with the Q&A. Just starting off now, looking at the market landscape. So obviously there's trends that impact both the buy and sell side, but we decided to split them up to start with, and we're starting with the sell side first. So I think the operating environment within the sell side can be characterized over the last 5 years as pretty negative in terms of revenue anyway. So you can see in the chart on the left hand side, trading revenues have fallen across the FIC and equity asset classes. And obviously in the traditional investment banking space, we will see revenues fall over the last 5 years. And this has put pressure on investment banks on their to maintain their operating margins. So what have they done? Obviously they focus on operation costs and how to reduce that cost. And they're doing that via things like focus on automation and obviously the subsequent lower headcounts. We're seeing headcount across investment banks come down over the last 10 years. Obviously outsourcing activities as well, where possible in the middle and back office. Sell-side firms are also investigating how they can generate new revenue streams. So that could be through offering additional services to the buy side or corporate clients. So many are kind of betting on that new data services, with focus on APIs or even bespoke analytics. For example, Goldman Sachs last year offered Goldman Sachs Marquee platform, which essentially is a digital front end that will allow clients to consume data, analytics, and trading capabilities. Analytics, especially in the trading desk, is very much focused on the real-time requirements, and decisions need to be made at higher frequencies and higher speeds. So time to insight and on-demand processing power has become more paramount issue for these firms, and will continue to be an issue going forward. And obviously, lastly, regulatory pressures. That's quite clear. And since the financial crisis, a number of requirements have really put extreme pressure on sell-side firms, and obviously subsequently on the data management teams and data infrastructure. The Basel requirements, capital requirements and calculations, focus on counterparty credit risk and variations. I think the focus on data has really been made prominent by the Basel Committee on Banking Supervision Standards number 239, where they really focus on the globally systemic important banks, and that kind of really is rules around aggregation of risk data and reporting. So moving on to the buy side, again, very similar, both on the cost side and the revenue side, impacts recent trends. So obviously operating margins have been squeezed. We hear a lot of things about passive investments, and as well as obviously underperformance that has really pushed active fees down. We have firms investing, really on a long history of cost reduction measures, whether that's rationalizing technology systems, focus on automation, or again, looking to outsource to varying degrees. The buy side, we're even seeing outsourcing within the trading desk itself. So, lots of firms are looking for new ways to save on costs. But obviously on the revenue side, there's opportunities, expansion of different products. So there's the growth of alternatives into new regions, so joint ventures in East Asia, for example. Obviously proliferation of ESG type strategies or quantamental type strategies, where you combine fundamental and quantamental approaches. We also see firms start to bet on data analytics. So not only on the investment side, obviously to help deliver alpha, but to really focus on understanding the clients better and understanding operations and improving them. And obviously you can't you have to mention regulatory pressure as well for the buy side. We've seen MiFID II back in 2018 still causing problems for firms. PRIPS again coming up in Europe, and obviously for the US is the SEC modernization rules that's pushing pressure on firms. But no matter the environment, I think the things that we've kind of stated already, it really puts a lot of pressure on existing data management infrastructures and governance approaches. And whether firms looking to adopt, ML for supporting data analytics or moving to cloud environments, they really invest in, elastic demand for computing power, then, really that really depends on the data infrastructure. And I think this is why we themed the 2 research papers that we wrote on behalf of InterSystems for the buy and sell side around, why C-suites really care about data management, and they should need to pay a bit more attention to this area. And Joe, maybe you have some thoughts on the current environment in capital markets, having talked to your clients around the pressures they're facing.
Yeah, thanks, Paul. I would say that this data jives pretty well with what we're seeing from our clients as well. I would say it's certainly not surprising that the top trends across both the buy side and sell side are around dealing with the impact of reduced revenues and margin compression. Right, especially over the recent few months or so, as we're seeing retail commissions being cut to 0 by many firms. So it's creating all sorts of pressure. And obviously the impact of this that we see from our customers is that they're always looking for ways to bring down operating costs. Whether that be in terms of infrastructure costs or ongoing maintenance costs, and certainly now more than ever. I would say another impact that we see is around the need for greater agility. So we see that our customers want to be able to develop and deploy new services faster and bring these new services to market that can potentially generate new revenue streams or that are competitively advantaged so that they can start to capture market share from their competitors. And we see things like next generation wealth management platforms that can deliver, quantitatively better investment returns for their clients. One of the things that you brought up on the previous slide on the sell side, the focus on the real time as a key initiative. And we see that as well, especially around the front and the middle office. So the need that we see is the result is the need for high performance infrastructure that's highly reliable, that can process real-time transactions at scale with very low latency, along with running analytics on the real-time data and on the historical and reference data concurrently, all at the same time, all in real time. And to be able to do this without having to brute force it and massively scale out infrastructure so that they're not increasing infrastructure costs. And then the final thing that I want to comment on is, it's no surprise that Paul and Aite found regulatory pressures on both the buy side and the sell side. And what this means in terms of data and technology is that the firms need access to clean, integrated, harmonized data from across the enterprise, and to have the agility to be able to respond to changes in regulations and to answer unplanned ad hoc queries from regulators quickly and accurately. And so they need the infrastructure in place to be able to do that. Paul?
Perfect. Thanks, Joe, for going into that detail. I think some of your findings really echoes with the next few discussion points around the data challenges. I guess the hurdles that firms are experiencing as a result of their current data architecture and current data setups. So obviously the largest portion, if you look at the slide on the chart there, have indicated that over 40% see that data quality and dirty data is a major challenge due to current setups. And this is quite a high number when you think about it, considering all the major functions across a bank or asset manager that depends on clean and accurate data supporting day-to-day activities. And also you have to service clients and you have to report to regulators, which are both mission critical. It's a worrying figure, but at least I think there's an acknowledgement from the industry that there's a problem, and that's the first step. And many firms are beginning to put in place strategies or technologies to overcome that issue. You know, as the common industry saying goes, when you put rubbish in, you get rubbish out. So that's what kind of refers to the use of incomplete or dirty data, resulting in kind of valueless or meaningless outcomes as a part of the different business functions that use that data. So I think most of the other challenges, you know, are very much linked to either the cost side or the revenue side. So, you know, high staffing costs, you know, that's a result of the manual data cleanup tasks that firms have to do as a result of the current architecture. And the delay resulting from that process means that business heads are unable to make decisions in a timely manner. There's also linked some of the results are linked to the need for increased reconciliations, right? When you have things like multiple silos or data silos, and firms lack that centralized data layer, that's a kind of a very significant problem for at least a third of firms. Poor data infrastructure can also impact the speed of integration across the firm, you know, delaying improvements and extending implementation times and costs. So, you know, all that, you know, can have a really significant cost impact. On the revenue side, there's also time spent by those end users on fixing data, cleaning data that's not spent on, you know, engaged in, you know, revenue generating activities or value added services. And this is often the kind of biggest complaint I receive from, you know, performance measurement teams at asset management firms, that spending too much time dealing with cleaning the data and getting the data right rather than actually performing the analysis itself. That's a big concern. So, well, it's also the same thing if you're trying to, you know, release a new market to new instrument to the market, or trying to trade a new instrument. You know, fractional differences in the speed to market against a competitor can lead to loss in market share and revenue. I think, you know, this time is probably a good time to go a little bit more into kind of the silos, as that's kind of a major problem that we're seeing in both the capital markets, and both the buy side and the sell side. However, it's probably a little bit more common on the sell side, based on the, you know, the study that we did. As you can see in the chart there, you know, seven out of the half of the firms that we spoke to, you know, were extremely siloed. And I think the difference between the buy and sell side kind of links to the scale of the business of the banks across all the different products and business lines. When you're on the buy side, you just have perhaps a geographical split, or you have a client focus split, whether that's kind of retail, institutional. You know, and the sell side bank is a larger institution there. And obviously, trying to solve issues with silos means centralized data infrastructure is required, or firms really need to adopt a consistent metadata level approach and a data model that's consistent across the silos, that helps with integration and supports the use of data from multiple sources. You know, a lack of such a framework will probably lead to, again, the issues that we already mentioned, which is, you know, increased reconciliation required, data cleansing activities, and anything that's kind of manual in nature, and that might require bespoke technology workarounds. You know, these things kind of lead to operational risk, and also key person risk, something for that, you know, firms need to really consider. However, I would say the industry, many have already begun to tackle the problems around silos, but have also indicated that, you know, sometimes the issue is not technology, it's to do with organization and culture. And so I think firms may lack a coordinated strategy to help with this. But at the same time, you know, we're not saying that absolute centralization is the end goal, but some consistent approach across teams is needed, and especially around the use of shared infrastructure. That's all going to help firms with their, you know, digital transformation projects, which many firms are currently undertaking. Joe, I mean, do you have any thoughts on what's happening in the data silo space? You know, is that a big issue for your clients?
Yeah, on data silos, absolutely. I totally agree. Huge problem with pretty much every organization we work with. And, you know, I will tell you, I was actually surprised to see that in your data, 2 firms said that their data is entirely centralized and they have no problems with siloed data. I'd definitely like to go talk to those firms. So, I mean, I'll tell you what we see. I mean, clearly access to clean, aggregated, accurate, harmonized data is really the lifeblood of every organization. And a lot of these organizations and financial services are dealing with, you know, hundreds or thousands of different systems and data stores. They exist in different formats. And, you know, it's, as companies are chipping away at it, it continues really to be an ongoing challenge for pretty much every firm that we work with. And it's not just in capital markets or financial services, by the way. I mean, it's a pervasive problem in pretty much every industry. So, I would say from our perspective, we spend a lot of time working with our customers to help them bridge silos, to integrate and transform and normalize and harmonize their data assets so that they can gain a real-time, accurate, panoramic view of all their data assets without necessarily having to move the data around, right? So you typically want to keep the data in the operational systems where they are, but you want to have this panoramic view. And so one way to do that, I mean, it's true you can create a normalized data lake, and we do that for many of our customers, where it's more than just dumping the raw data, it's having access to the data that you need. But I think a different approach and a more interesting approach is a lot of firms are building a data fabric, a scalable data fabric, where you're able to house and use and access and combine and analyze any of the data that you need from across the organization with very high performance. And also within the data fabric, you want to have an embedded intelligence layer that allows you to run various kinds of analytics on the harmonized data, right? And so sometimes that looks like business rules for pre-trade analytics, but it can also mean running predictive analytics and machine learning, whether it's for portfolio simulations or looking for new ways to increase alpha, or for risk management or regulatory compliance, for reconciliation and so forth. So yeah, silos continues to be a huge ongoing problem, and gaining access to clean, harmonized, healthy data is a prerequisite for most of these kinds of initiatives. And clearly, as we see from the research data, it's still an ongoing problem for most organizations. Right, Paul?
Perfect, thanks, Joe. And going to the issues around data, I think it's a good time to transition to looking at what teams are actually putting the most pressure on sales side and buy side institutions around the data management teams and data infrastructure. And no surprise there that trading and regulatory compliance, two areas that we kind of mentioned quite a number of times already, are placing the most pressure on these teams, on data management teams in the sell side. Obviously, the focus on real time on the desk is a big factor, right? It's always been high frequency, high volume business, especially it's very important for reliability as well during times of market turmoil. Consequently, latency issues can come about, and I think legacy architecture has become somewhat overburdened with additional requirements. Especially when the use of algorithmic trading, real-time analytics such as transaction cost analysis, pre-trade, and various flavors of valuation adjustments, commonly known as XVAs in the industry. These are the things that need to be done to accurately price trades in the face of identified risks and costs to the bank, especially around funding costs and capital costs. On the regulation side, we mentioned some of the regulations that the sell side firms have faced, but there's upcoming ones like FRTB, Fundamental Review of the Trading Book, and regulators are keen to see an audit trail on all this, and means that data must be tagged with metadata to prove lineage and provenance. And fines are also a big worry for the C-suite now, and along with the reputational impacts when regulators act, that's big news. And I think there was 2 fines last year related to MiFID reporting failures at 2 large institutions, 2 banks, that amounted to over $70 million. So obviously these are no trivial sums. So again, these teams are definitely putting the pressure on data management infrastructure. For the buy side, again, no surprise, it's portfolio management, which is the vital function, the lifeblood of the asset management world. And I think firms, at the moment need to ensure consistency in how performance, for example, is attributed in internal portfolio management views versus how clients see that. So there's a consistency and connection there, especially when portfolio managers talk about results. There's also an internal need for consistency between performance, risk, and client reporting. So because all these data tends to come from siloed applications and they all pass through each other, there's an inherent need to be confident within the results, and any kind of, I guess, worries about the quality impacts the speed of delivery from these teams. And institutional clients are also starting to expect self-service capabilities, so they want access to some of the underlying data, which was traditionally contained in these static PDF reports. I think we're starting to move away from that. So put really a lot of pressure on data management teams and data management infrastructure to help provide and support all these things that are going on. Joe, I mean, are you seeing the same things, and these teams across your clients are putting the same pressures as experienced by some of the firms that we interviewed?
Yeah, thanks, Paul. This is a really interesting slide for us because, as I mentioned earlier, where we play is typically in the areas where there's the most challenging data and analytics initiatives. So a lot around real time with lots of data and lots of calculations and low latency and so forth. And so, obviously that maps to, on this slide, the functional areas that are putting the most strain or the most pressure on data architecture. So I would say this is pretty consistent with what we're seeing as well. Trading platforms, number one on the list, absolutely. We do a lot of work there because the strain on architecture from trading platforms is around handling real-time, low latency processing of incoming messages, transactions, with the ability to run real-time analytics on the transactions that are coming in to feed the downstream operational systems, all in real time. And then, as we're seeing now, the ability to handle these unexpected, unplanned spikes in message volumes. What we've seen over the last few weeks or so has been unprecedented in terms of unplanned spikes. And so the infrastructure needs to not only be able to accommodate that, but to do it with perfect reliability and without having to spend like crazy to provision unused headroom, just in case something happens, and to be able to do all this while still, per the previous discussion, keeping infrastructure costs down. And on the sell side also, it tends to be more pronounced than on the buy side, where on the sell side workloads can get very high as an already high volume of orders get chopped into even smaller child orders for execution. On the buy side, we see for portfolio management, we do a lot of work there as well, and the more simulations that you can run faster using more data, the better, in theory, the returns that the better returns that you can deliver for your clients. And again, the way that many clients accomplish this is by implementing a normalized data lake with a scalable data fabric, like I described earlier, where you can run more analytics on more data in less time. The other thing that I would say, though, is we do see some areas, some demands that aren't on the slide, like post-trade management functions and back office processing functions. And for example, for the back office, even though the latency isn't as critical as in the front office, you don't have real-time requirements, our customers still want to be able to scale efficiently and cost-effectively, keeping their infrastructure costs down as data volumes grow, both through M&A activities and through organic growth. So yeah, I would say, this is pretty consistent with what we see, and we do see some other areas, other functions as well, putting strain on data architecture. Paul?
Perfect, thanks for bringing up the back office operations and deployment of data management and latency for them. Now moving on to looking at, I guess, what is hindering firms the most when it comes to moving towards their data management goals, and obviously moving to their desired operating models and to become a kind of a data-driven business. And I think, whether the leadership at the time at the first certain firm is a CDO, chief data officer, or any other kind of executive, it's quite a difficult task, because you have to effectively manage data across both the operational and obviously geographical silos, and also try to introduce a culture of data responsibility within the business. And you're supposed to do that at the same time as managing tactical and strategic targets around different projects, and obviously all at the same time trying to save costs. I mean, it's quite a challenge. And I think, as we mentioned before, there are factors outside of technology that can really hinder firms. That's around culture, lack of buy-in from leadership or from the grassroots level can definitely hinder firms. And other factors, again, which might determine the best approaches. I think, really helping firms determine which best approach that they should have in terms of delivering data to business on the technology side. That's kind of a key consideration as well. And I think lots of firms will even have problems with even developing a data operating model. One bank that we talked to noticed that they had silos, but they were on a business function level. And what they did was, for firms metadata management, they tried to centralize that, and then they use obviously a centralized data governance tool as well as data quality issue management tool. So they have that centralized. So the governance is centralized, but the management a little bit more federated. And I think this is probably a good time to transition into talking about target operating models, and on what firms have been doing or suggesting as feedback that we received. We described the process of planning around a data operating model in the reports, kind of similar to a game of chess and when you're trying to checkmate a king without the ability to visualize everything. The first critical question is, how much does a firm want to become data driven? And the answer, based on interviews, is usually very. Many institutions are embarked on certain data management initiatives or specific functions, and some of those link to larger enterprise-wide digital transformation projects that we hear about. A recommendation from the study participants is really to ensure that any kind of project is linked to some measurable outcomes. For example, the data lake example, what's the purpose of the data lake? Ask these type of questions. What types of data will be stored? How will the data be accessed? What analytics or teams does it feed? Is there actually demands from multiple business lines? Is it the best technology available currently for the needs? And so all these questions need to be answered. And also we have a list of some of the goals that the market participants that we interviewed suggested that firms should really consider. Around how to best aggregate data, about how to reduce latency, about how to get data to the right people, and also about prioritization. And at the same time, we've looked at the importance of many institutions have kind of made note of the importance of data governance and data and management from a organizational perspective. That's kind of highly important as well. And things that do come up is around the federated data approach to data management. And I think it was in our IT Group's top 10 trends for 2020 where we talked about this first. We talked about how the industry is probably moving to the federated approach direction, and we've kind of depicted one bank's current setup that's kind of followed this model, and we feel that this is probably the model that will proliferate across capital markets as we move forward. And at the top you have the centralized portion of the business to drive direction and standards. Obviously create those common taxonomies and establish new ways of introducing new types of data into the business, and that's obviously quite important when you think about alternative data and the rise of that in financial institutions at the moment. Obviously leadership is important as well to drive that cultural change. IT Group estimates that I think 38% of sell-side firms have a CDO or multiple CDOs, and 25% of buy-side firms. However, I think many respondents in our study also suggested that CDOs roles are kind of linked to the introduction of data analytics or big data projects alone, rather than having kind of a full operational responsibility for the data management and governance across all the different areas. So this is probably something that the industry needs to address and improve upon. And again, looking at this particular bank's structure, for them, the CDO definitely sits at the top, but then they obviously have to help, to drive the strategy and to help coordinate projects such as cloud migration, and obviously coordination with the technology teams. But then at the same time, they also have set up stewardship programs across the business lines and appointed individuals in those teams to enforce standards. I think a few things are important here. Communication, engagement, and prioritization that come out of this model. So obviously that feedback loop between the business and the executive, the management team is highly important to make sure the direction is going, the results are delivering what the business wants, and if there's internal changes and requirements, and then that's obviously fed back to the management team. And then obviously the management has to take off all this data and try to prioritize best as they could to deliver the most value to the wider organization. It's about getting the best bang for your buck. But this again, it's highly important, I think, to consider the data governance model. Joe, any thoughts on what I've said so far?
Yeah, thanks, Paul. This slide and this structure, or something a similar structure, is really interesting. I mean, and I think that's right. I mean, we see some of this as well. But what I would say is that even when you have a nice centralized organizational structure, many times it can be really hard to boil the ocean with big top-down initiatives. And so, as you said, Paul, what we do see from our perspective is much more around department. Even when there's an organizational structure in place like this, rather than top-down boil the ocean initiatives, more department or function level initiatives that create value and an ROI that's measurable at the department level, like for order management or post-trade management or back office functions. And where the firm does have top-down data governance standards in place, and make sure that the implementations comply with the top-down standards. But what we see is mostly bottom-up function or operation-specific initiatives that generate real quantitative, quantifiable ROI. The other thing that I would say is we rarely see big rip and replace initiatives. And so, these department and function specific initiatives, any new initiatives that we see, the implementations have to play nicely with the firm's existing technology infrastructure so that they're complementary rather than some big bang rip and replace initiative. Okay, so that's what we see. Paul?
Perfect. I can definitely agree with that. Delivering results quicker definitely helps with maintaining that buy-in from the different teams and across the organization when they see results. Let's transition now to look at, examine some of the drivers of the recent investments that firms have made, and also look at some trends in adoption of machine learning and scale of cloud migration as we look into these factors. Again, really stressing the point that any kind of data investment needs to be focused on demonstrating that value to the business, so that that firms don't lose faith in the project itself. So far, kind of sell-side firms have placed abilities to support faster time to market, increased granularity of analytics, and improve reliability for resilience. That's kind of the main drivers, and you can see that highlighted as the very important factors in recent projects. I don't see that contrast with the buy side there, but sticking with the sell side for now, I mean, obviously, again, it really iterates what we've been saying before, responding to client requirements, trading opportunities, supporting new asset classes and geographies, all relates to faster time to market. It's very important in this competitive landscape. Obviously, the ability to drill down to more granular level, that's when you're trying to derive insights that competitors may have missed. And it's really important to nearly 2/3 of all sell-side respondents. Lastly, the reliability of infrastructure. We don't have to stress that again, especially during this time. of market volatility. And for the buy side, it's interesting actually, because where reliability becomes the #1 factor of recent data management investments. And I think that, it's very important at the moment, and we've seen a lot of firms have made recent investments in enterprise data management and master data management solutions to ensure that that golden copy of data can be used across the businesses. And obviously that links to the managing that multiple data representations. You got the internal view, you got the client view, so you need to manage both. And obviously the ability to drill down at a more granular level, that's again part and parcel to the investment manager's role, and the need to quickly change models to be able to dig down to instrument level, security level, some of that analytics, rather than keeping that high level at the portfolio level. So again, those are the major drivers that we've seen from the study. Joe, any comments on the drivers there that you see?
Yeah, thanks, Paul. So these map to the 4 key themes that we see as well. So one is around data. So better data management, real-time access to data, the reliability of the data, being able to drill down into the granular data when you need to, getting value from the data, right? And so from a technology standpoint, that's all about scalable data management, bridging silos and data fabrics and so on. Number 2 is around agility. So being able to access the data that's needed and the ability to develop new services and bring new services online quickly. The third is around increasing performance and throughput and scalability, while at the same time, not only not increasing costs, but actually reducing the infrastructure costs as you're increasing performance and throughput and scalability. And the fourth theme that we see here, and we see it as well from our customers, is the ability to add intelligence through business rules and predictive analytics and machine learning and AI, and embedding this intelligence into processes. And I think that maps pretty well to the data that you have here on the slide as well, Paul. Okay, thanks.
Great, thank you very much for that, Joe. Now looking at kind of the hot topic again, machine learning, AI, very topical in the capital markets discussion recently. And we kind of tried to gauge the scale of adoption and the impact on data infrastructure with the studies that we have completed. Based on the research, machine learning and AI are not yet widely as adopted on the buy side when you look at the data there as compared to the sell side. But the majority of respondents are either considering the application or already piloting some of this technology in certain areas. For example, one of the bank-owned asset managers that we spoke to, is looking at how machine learning can help with managing client data and for quantitative support. But they've stressed that it's very limited in application so far. And another firm on the buy side, they expect that they can use AI to replace some of the firm's higher end functions because of the technology's ability to evaluate business logic and rules and create them programmatically, apply them to data sets on the investment side. But again, pilot stage at the moment. There's one sell-side bank that we spoke to actually that already had big data analytics and science teams embedded across the entire business functions. So this is a large bank, but they had around 20 teams, different teams using data science at different maturities and expertise levels. And the central data function they have there is trying to coordinate the best practice and standards for those teams, and always to provide that common infrastructure that can help set the foundation. So I think at that bank in particular, I think they have really stressed that they're trying to tie data analytics closer to the actual operation systems and environment. Because right now, analytics has been done on the copies of data, right? It's not done on the operational data, but they expect that the lines between the two start to blur as more and more machine learning has become is embedded within the firm. And again, based on the feedback, no matter the application, the true value of AI and machine learning, I mean, it can be applied in multiple situations, and we see that, but it really is fundamental to get the data story correct and get it right to be able to support consistent approaches across a large scale business, and really to make successful use of this type of technology. Joe, any thoughts on machine learning and AI?
Yeah, it's really interesting. I love the story about the firm that has data scientists spread across 20 teams and embedded in throughout the business. And I think if you read all the hype, you would think that it's widespread and commonplace, but clearly the reality is that it's not. I think most organizations that we deal with, they know that there are many places in their organization where machine learning can deliver business value, from investment management to trading to reconciliation and so forth. But I think this data that you're showing is right. There's a lot of interest. There's a lot of hype. Almost everybody is at least actively considering it, if not piloting it. But in terms of widespread adoption and production implementations, it's still early, and there are still some bottlenecks that organizations are trying to work through. So one of those that we see is that machine learning is heavily dependent, again, on access to clean data, right? And depending on the surveys that you read, somewhere between 70 and 85% of all of the effort from data scientists, how they spend their day, it's with around data munging and integration and data wrangling and so forth. So many of the things that we've been talking about around integrating and cleansing and harmonizing the data are all prerequisites for widespread sort of implementation and adoption of machine learning models. But clearly, the other place where there's a bottleneck is there's still a significant shortage of skilled data scientists to do the work, right? And so what we're seeing now is that in response, there's a number of technology companies, including ours, that are starting to do a lot with what's called auto ML, where you don't necessarily need to be a data scientist to develop accurate machine learning models, as long as you have access to enough accurate, detailed historical data. And so that's starting to have an impact, or if you do have skilled data scientists, using auto ML tools can automate a lot of the tedious work, so it can help them get more done, have them be more productive, have their efforts be more scalable across more projects across the organization. So yeah, there are some exciting new technologies and advancements happening that should help with these bottlenecks, and I think that we will see a lot higher adoption of production deployments of machine learning in the near future. But still, there are many firms that are still sort of in the piloting or brainstorming and consideration phase. Paul?
Perfect. Thanks, Joe, for going into that detail. I think we're just going to transition to the last slide on my part and the study around cloud adoption. IT Group has talked about the cloud and migration to the cloud over the years, and our estimates put majority of tier 1 sell-side banks and global asset management firms having less than 10% of their total technology stack in a public cloud environment. I think obviously the industry as a whole has been slower than some of the other industries around cloud adoption. Cybersecurity, data security risks have been all on the radar for market participants over many years now. And obviously C-suite's kind of worried about the move, especially when you're trying to move mission critical systems to the cloud. There's also that cultural and operational hurdle to overcome before a firm can really adopt a cloud first approach. And that's something that, for a term that we've kind of been hearing a lot firms want to do. And it's also kind of difficult when you think about it, because enterprise level innovation within capital markets it's much lower than the actual functional specific innovation. So when you talk about maybe the front office only, it's a lot quicker than you're trying to move the whole company. So given the cloud is viewed as a more enterprise decision, it's unsurprising that the size and existing technology footprint of the firm will have an impact on how much firms will consider the cloud technology and moving to the cloud. So the momentum is there, though. I mean, definitely in most of the interviews that we had, it's been very positive in terms of forward projections, and that's reflected in the results of the presented in the chart there. I think very much focused on which technology to move first, whether that's legacy non-client facing post-trade operations, which tends to be hosted on-premise. And I think it's going to be kept on premise for a while because they're seen as lower priorities and cost centers. And again, maybe in the research development side, marketing, email, this stuff will be moved and has been moved already to the cloud. And we're starting to see that. And I think one bank had an interesting comment, which was around the future, which was they think the future is hybrid, right? In a hybrid environment. So we have on-premise and cloud working together, as well as even hybrid clouds. So they want to make sure that their analytics provisions and their access frameworks are all cloud agnostic. And I think that's an assessment that we quite agree with, the hybrid situation moving forward. Joe, any kind of comments here before we move to your section?
Yeah, the only recommendation that I would make here with respect to the cloud, based on our experience with our customers, is to make sure that as you're moving to the cloud, that you don't lock yourself into one cloud provider. You want to make sure you have the flexibility to run in a hybrid environment, whether that's public-private, or cloud and on-prem. I will tell you that we see scenarios where a customer was running on one of the major public clouds, and then all of a sudden a different cloud vendor made them a financial offer that they couldn't refuse. But they were, in working with us, they were smart, and they implemented their applications in a way where they weren't tied into any specific cloud vendor. So they were able to move to another public cloud without having to rewrite anything. It was the one API without any changes. So as you're thinking about architecting or moving to the cloud, be sure not to lock yourself into the services and the APIs that are specific to any one cloud vendor, or else it'll be difficult and expensive to move. Paul?
Perfect. Well, I think this is where we'll transition to you and to talk about InterSystems a little bit more.
Oh, thank you very much. So just very quickly, for the folks on the phone, I wanted to give you just a quick overview about InterSystems, in case you're not aware of our company. We may be the largest software company that you may never heard of, and a reason for that is even though we are powering some of the largest data-driven applications that are in production in the world, we're inside those applications like trading platforms and so forth. So we're like the Intel Inside for data-intensive applications across many industries, including a very deep footprint in financial services. We're running in production at most of the top global banks around the world. On any given day, our software is used to power up to 15% of the worldwide equity trades. In addition to our presence across financial services and capital markets, our software is also used in other heavily regulated industries that have very high security requirements. For example, in healthcare, it's used to manage the electronic health records of more than 1 billion patients with a B around the world. That's about 1/7 of the entire world's population. So if you think about lots of data in different formats, with extremely high security and reliability requirements. Another example, it's used by the European Space Agency, which is Europe's version of NASA, and they're using it to create the largest, most detailed map of the Milky Way galaxy ever created. Currently more than 30 billion observations and growing, and this is what all the astronomers and astrophysicists are using now and into the foreseeable future for their calculations and to map the galaxy. If you go to the next slide, just to give you an idea of our presence in capital markets on the next slide, Paul, thank you. This is a subset of where our customers are using our software throughout front, middle, and back office processes. And again, typically we're used where, our sweet spot is where there are a high level of transactional workloads, so very high ingest rates, high levels of analytic workloads that are operating on very large distributed data sets for organizations that are dealing with data silos where data exists in different systems and in different formats, and they need a panoramic, consistent view, secure access to all of that data for visibility and for combining the data and analytics and so forth, and where there's a need for very high security and reliability, as is the case with pretty much every one of these customer implementations that you see on the screen. So very quickly, if we go to the next slide. So the last slide, I just wanted to share with you a typical implementation for us. So this is a customer. We actually started working with this firm in the mid-2000s. It's one of the top global investment banks. They have about $800 billion US in assets under management. They have about 50,000 employees. They're processing billions of orders every day. They're running real-time analytic queries on that transactional data and on other data to serve 300 downstream applications. So when we first started working with this customer, they had scalability and reliability problems with their order management system whenever the market spiked. Whenever that happened and the market went down, it would cost them hundreds of thousands of dollars for every minute of downtime. So it was really a problem. And then around 2000, when the dot-com crash occurred, that was the end of the current system that they had in place. So they brought in a new team, and at that time they POC'd all the usual suspects for data management vendors, and they chose InterSystems. And at that time, in the early to mid 2000s, they deployed their new order management system using our software. So since that time, and they've been a customer ever since, up until now and going forward, clearly order volumes have grown. And their order management system has not only handled that growth, but it's been extended from equities only now to handle multi-asset trades, not just equities. In addition, the result is that they now have a 3 to 5 times increase in throughput. Their ingest performance is 10 times faster than it was before. Right? And on top of all of the performance and throughput gains, it's 75% less expensive in operational cost. So it's exactly what we have been talking about throughout this webinar. But I would say probably the most important benefit to the firm, though, is that when trading volumes spike without warning, like they did in 2008, and clearly as they've been doing over the past month, they've had zero performance or reliability issues. The system doesn't slow down, it doesn't drop trades, it doesn't fail. And so for them, this bulletproof reliability and knowing that they can depend on their infrastructure even when the market goes crazy like it is now is the biggest benefit to them. So with that, Siobhan, I'd like to hand it back to you if we have some time for a few questions, please.
Yeah, unfortunately, we're kind of at the top of the hour here, so we will plan to follow up with you separately if you submitted a question through the Q&A feature. But I would like to take this time to thank Paul and Joe for all their great insights. That was a lot of content to get through. I'd also like to take this time to thank all of our attendees for joining us. I hope you found the session informative. Just as a reminder, a recording of the webinar will be available on demand. Just look for an email from InterSystems to be sent out within the next 24 to 48 hours with more details on how to view the recording. If you have any questions about today's webinar topic or would like additional information about any of our other IT Group services, please email us at info@itgroup.com. If you have any questions for InterSystems and their services, please contact InterSystems at